In September of 2025, one company made a promise that stopped Wall Street cold. It offered to hand a customer up to $100 billion. There was just one condition. The customer had to take that money and spend it buying the same company's products. Read that again. A supplier funding its own buyer, so the buyer can afford to buy from the supplier. If that sounds strange to you, good, it should. Because the company doing it is the most valuable business on the planet, and the way this money moves may be quietly telling us something about the entire artificial intelligence boom. Let me be fair first. Nvidia is a genuinely incredible company. It builds the chips that basically every serious AI model on Earth runs on. It controls something like 80 to 90% of the market for AI accelerators. It went from a graphics card company for gamers to briefly the most valuable corporation in human history. If you love engineering, if you love silicon, this is a masterpiece of a company. Objectively, that is astonishing, but now there's a problem. And it's not an engineering problem, it's a money problem. Because more and more, Nvidia isn't just selling chips, it's funding the companies that buy them. And that particular trick has a name. It's called vendor financing, or less politely, circular financing. And the last time an industry leaned this hard on it, the whole thing collapsed and took trillions of dollars down with it. So the question I want to answer today is simple. Is Nvidia building the future, or is it quietly building a machine that inflates its own demand? And if the money is moving in circles, what happens when the circle finally breaks? A quick disclaimer before we start. None of this is financial advice. If you want to buy the stock, buy it. If you don't. But let's get into it. Here's a taste of what people who actually study this for a living are saying. One analyst at Bernstein Research wrote in a note to investors that the deal would, quote, clearly fuel circular concerns. Others have compared the whole setup directly to the vendor financing collapse of the dot-com era. And when reporters started asking hard questions, the CEOs involved got defensive fast. One called the concerns nonsense. Another insisted the $100 billion was never a commitment. We'll get to why that walkback matters. Trust me, it matters a lot. The loop. For years, Nvidia earned its position the hard and old-fashioned way. It made the best chip. It built the software that everyone learned to code on, and it out-executed everyone else. There was no trick, it just won. But in the last 2 years, something changed. Nvidia stopped only being a seller. It became an investor, a financier, a bank with a chip factory attached. The clearest example is the OpenAI deal. In September of 2025, Nvidia agreed to invest up to $100 billion into OpenAI. The money was meant to fund a massive build-out of data centers. We're talking about at least 10 gigawatts of computing capacity. To put that in human terms, that's roughly enough electricity to power a major city. Now here's the part that raised eyebrows. In return for that money, OpenAI committed to filling those data centers with Nvidia chips, millions of them. By some estimates, 10 gigawatts works out to somewhere around 4 to 5 million graphics processing units. Which, by the way, is roughly the total number of these chips Nvidia expected to ship in an entire year. So follow the money. Nvidia gives OpenAI cash. OpenAI uses that cash to buy Nvidia chips. Nvidia records those chip sales as revenue. Revenue goes up, the stock goes up, and the first $10 billion only gets released once the first gigawatt of capacity is actually running, with the rest rolling out in stages. And here's a detail that makes it even stranger. Analysts pointed out that the revenue Nvidia stands to earn from just 1 gigawatt of that build-out could be larger than the amount it invests to make it happen. In other words, Nvidia might put in the money and get back even more than that in chip sales for the very same slice of capacity. The investment isn't just funding a customer, it's a seed that grows into a bigger harvest, paid straight back to the company that planted it. On paper, it looks brilliant. Nvidia locks in a giant future customer. OpenAI gets the cash it desperately needs to expand. Everybody wins. Nvidia itself framed the whole thing as a chance to invest early in what it called the next multi-trillion-dollar company. But strip away the excitement and what you're really looking at is a company funding its own sales. The demand isn't fully coming from the outside world. Some of it is being manufactured from the inside. And when a company starts generating its own demand with its own money, that raises a very uncomfortable question. How much of this booming demand is actually real? It's not just one deal? Okay, but maybe OpenAI is a one-off. Maybe it's a special case. A single big bet on the most famous name in AI. Well, perhaps not, because when you pull back, the OpenAI deal isn't the exception. It's the pattern. According to data from PitchBook, Nvidia took part in more than 50 different venture investment deals for AI companies in 2024 alone, and it was on pace to beat that number the following year. 50 in a single year. And these aren't random little bets. Look at the web. Nvidia invested in xAI, Elon Musk's AI company. It invested in Mistral, the big European model maker. It backed a whole crop of what the industry calls neoclouds, companies that basically rent out access to Nvidia chips, names like Nscale and Nebius. It took a roughly 7% stake in CoreWeave, and then agreed to buy over $6 billion of computing capacity from that very same company. Sit with that one for a second. Nvidia buys a piece of CoreWeave. CoreWeave buys Nvidia chips. Then Nvidia turns around and rents capacity back from CoreWeave. The money doesn't so much flow as it spins. And it goes further. A competitor, AMD, cut its own deal with OpenAI involving stock warrants tied to buying AMD chips. OpenAI signed a cloud deal with Oracle reported to be worth around $300 billion. And then there's Stargate, a joint venture between OpenAI, Oracle, SoftBank, and others, with a headline number of $500 billion to build data centers across America. Everybody is investing in everybody. Everybody is a supplier to everybody, and everybody is a customer of everybody. The result is a dense, tangled web of companies whose fates are now bolted together. If one big player wobbles, it doesn't fall alone. It pulls on every thread connected to it, and the scale of the promises being thrown around is almost hard to believe. Add up the headline commitments floating through this ecosystem and you're staring at numbers in the trillions. One respected industry voice has estimated that the gap between what's being spent on AI infrastructure and the revenue needed to justify it has grown to something like $600 billion. $600 billion. That's not the spending, that's the whole. That's the amount of real paying demand that would need to appear out of thin air just to make the current build-out make sense. Now, defenders will say this is just how ambitious industries work. Big players back promising customers all the time, and that's fair. Vendor financing exists in plenty of industries and isn't automatically a scam. But there's a difference between a little of it at the edges and an entire industry's growth story resting on companies passing the same dollars back and forth. When the biggest supplier, the biggest customer, and the biggest lender all start to look like the same small circle of names, you're no longer looking at a market. You're looking at a hall of mirrors. Why this inflates the picture? Here's where it gets really interesting and a little uncomfortable. When money moves in a circle like this, it can create the illusion of demand that isn't fully there. It's a bit like lending your friend $20, watching them immediately buy a $20 item from your shop, and then telling everyone your sales are booming. Technically true, but you funded the sale yourself. Analysts have a blunt word for the risk here: round-tripping. Money leaves through one door as an investment and comes back through another door as revenue, and the company looks healthier than the underlying reality supports. There's a second layer to this too, and it's about a nasty little detail called depreciation. These AI chips do not last forever. In fact, they age fast. A cutting-edge chip today can be outclassed in about 3 years by the next generation. That's a brutal shelf life for hardware that costs tens of thousands of dollars a unit. Now in some of these arrangements, instead of making the customer buy the chips outright, the plan involves leasing them. Why does that matter? Because if you buy something that loses value that quickly, you have to record that loss on your books. It drags down your profits. By leasing instead, the buyer avoids taking that ugly charge. Their bottom line looks better, but somebody still has to eat the depreciation. And increasingly, that somebody is Nvidia itself. So think about what's happening. The demand is partly self-funded. The hardware is melting in value the moment it's installed, and the accounting is being arranged so the pain is pushed around rather than faced head-on. None of that is illegal. None of it is even unusual in a boom, but it's exactly the kind of thing that looks fine right up until the moment it doesn't. We have seen this movie before. If all of this feels familiar, that's because it is, almost eerily so. Rewind to the late 1990s. The internet was exploding. Everyone was certain that demand for bandwidth was about to grow forever, and a handful of giant equipment makers were selling the gear to build the internet's backbone. Companies like Lucent, Nortel, and Cisco. There was just one problem. A lot of the startups that wanted to buy this expensive equipment didn't have the cash. So the equipment makers came up with a solution. They lent the customers the money. Then the customers used that borrowed money to buy the equipment. And the equipment makers booked the sales as glorious, booming revenue. Sound familiar yet? The numbers were enormous for the time. Lucent committed over $8 billion in this kind of customer financing. Nortel extended several billion more. Cisco promised billions in customer loans of its own. The strategy seemed genius. Lend money to cash-strapped customers so they can buy your gear. Everybody wins. The merry-go-round spins faster and faster, and for a while, it worked beautifully. Cisco's value soared until, in March of 2000, it briefly became the most valuable company on the planet, worth around $450 billion. Lucent's revenue peaked near $38 billion. These were untouchable titans. Then the music stopped. The startups that had borrowed all that money couldn't generate enough real revenue to pay it back. Between 2000 and 2003, dozens of these telecom carriers went bankrupt. One count puts it at 47 of them, with names like Covad, Northpoint, and Windstar vanishing into history. And when the customers collapsed, the equipment makers were left holding the bag. All those loans, all that gear, suddenly worthless. The damage was staggering. Lucent's revenue crashed by nearly 70% in just a few years and never recovered. The technology survived. The internet obviously did just fine, but the companies that financed their own frenzy did not. The cracks are already showing. So here's the uncomfortable part. We may already be watching the early version of that same story play out. By early 2026, the mood had shifted. A major report claimed that Nvidia's $100 billion plan for OpenAI had, quote, stalled. Suddenly, the tone changed. Nvidia's CEO went on stage and clarified that the famous $100 billion figure was never a commitment. Instead, he said, Nvidia would invest one step at a time. Reporting suggested the real near-term number being discussed was closer to $30 billion than 100. And the reasons given included growing scrutiny of the whole circular arrangement and internal doubts about the business discipline of the companies involved. When that news hit, watch what happened to everyone connected by those threads I mentioned. Oracle, which had been borrowing heavily to build servers for OpenAI, saw its stock drop and rushed out a defensive statement insisting the Nvidia news had zero impact on its relationship with OpenAI. Now, when a company has to publicly announce that a scary event has zero impact, that statement often does more harm than good. It tells you people were absolutely connecting the dots. If Nvidia funds OpenAI and OpenAI pays Oracle, then a wobble in the first domino makes everyone stare nervously at the last one. And there's a newer twist that the 1990s didn't fully have. Those neo-cloud companies I mentioned, the ones renting out Nvidia chips, Wall Street has reportedly lent them more than $11 billion, and a big part of the collateral for those loans is the Nvidia chips themselves. Think about what that means. The value of the loan depends on the value of the chip, but the chip loses value fast and gets outdated in about 3 years. So if chip prices fall, whether from a new model release, softer demand, or competition, the collateral shrinks. And shrinking collateral can trigger margin calls and broken loan agreements. It's a fragile chain, and every link is a graphics chip that's aging by the day. Then there's the threat from Nvidia's own best customers. The biggest buyers of these chips are quietly trying to escape. Google builds its own AI chips. Amazon builds its own. Microsoft is working on its own. Even OpenAI reportedly placed a large order, worth billions, with another company to design custom chips of its own. Every single one of Nvidia's giant customers is working on a way to need Nvidia a little less. And when your customers are simultaneously your investments and your escape artists, that is a strange and precarious place to be. And underneath all of it sits the one question nobody in the loop really wants to answer out loud. Is this making money yet? The build-out is very real, the bills are very real, but the profits that are supposed to eventually justify all of it are still, to a large degree, a promise. The whole structure is built on the assumption that AI demand will grow exponentially, forever, without pause. And every part of that assumption, from the power grid to the supply chain to the patience of investors, is being tested at the same time. Remove any one of those supports and the math behind the loop gets shaky very quickly. The other side of the coin. Now, I'd be doing you a disservice if I only told you one side, because there are some real important differences between now and the year 2000, and honesty demands we look at them. The first and biggest one is where the money comes from. In the telecom bust, a lot of the vendor financing was fueled by debt. Companies borrowed to lend. That's leverage, and leverage is what turns a downturn into a wipeout. Nvidia, by contrast, is largely funding these investments out of its own enormous free cash flow. It is not betting the company on borrowed money. It has real profits, real products, and real cash. That is a genuinely different and much safer position. The second difference is that the demand here is not fake. Let me be clear about that. Millions of people use these AI tools every single day. Real businesses pay real money for real computing. The chips are not sitting in a warehouse unused. They are running, right now, all over the world. This is not a case of zero customers pretending to be a market. There is a real market underneath all of this. And third, honestly, betting against Nvidia has been a losing game for a very long time. Smart people have called the top over and over the company has blown past them. Maybe the demand really does keep growing. Maybe AI keeps expanding into every corner of the economy, and every one of these circular deals ends up backed by genuine, lasting, profitable use. Maybe the loop lands on solid ground, so I could be completely wrong here. A rabbit could get pulled out of the hat. I want to be fair about that. So what do we make of it? But here's where I land, at least for right now. The mechanism is real. Nvidia is increasingly funding the customers who buy its products, and that funding makes the demand look bigger and healthier than the raw outside world alone would support. That's vendor financing. We have a very clear historical example of where that road can lead, and it ended with some of the most dominant companies in the world losing most of their value and never fully coming back. The differences today are meaningful, especially the reliance on cash instead of debt. But the core dynamic, the money moving in a circle to prop up a boom, is unmistakably present. The real question was never whether the money loops. It clearly does. The real question is whether that loop eventually lands on solid, lasting, profitable demand from actual end users. If it does, this all looks like brilliant strategic investing, and the skeptics will look silly. If it doesn't, then we're watching a very expensive game of musical chairs, and nobody wants to be standing when the music stops. Genuinely healthy companies don't usually need to fund their own customers to keep the sales flowing. And when the most valuable company on earth starts doing exactly that, at a scale measured in the hundreds of billions, that's not a reason to panic, but it is absolutely a reason to pay very close attention. So what do you think? Is this the smartest set of bets in the history of technology? A company using its cash to build the entire future in its own image? Or is it a beautifully disguised money machine, spinning demand out of its own pocket? One that history suggests can only spin for so long. Let me know your thoughts.